far more ambitious quest to create an honest, reliable barometer of the American economy's health. He believed the stock market, for all its flaws, was the most powerful tool for this task, a sensitive mechanism that reflected the collective hopes and fears of an entire nation. To harness it, he first had to map it. We will begin by exploring the life of the man and the historical context that drove his mission. We will then deconstruct the tools he forged, the famous Dow Jones averages, and finally, we will begin our deep dive into the foundational tenets of his timeless theory. To understand the Dow theory, one must first understand the man. Charles Henry Dow was born on a farm in Connecticut in 1851. He was not a product of East Coast financial aristocracy. His upbringing was modest and his formal education ended at a young age. His true education began when he left the farm to pursue a career in journalism. As a young reporter, he developed a distinct style, a gift for explaining complex subjects in clear, concise language, and a deep fascination with business and economic history. He honed his craft at various newspapers, eventually landing at a financial news agency in New York City. It was here, in the heart of American capitalism, that he met Edward Jones, a fellow journalist who shared his commitment to honest, objective reporting. In 1882, the two men, along with Charles Bergstresser, founded Dow Jones and Company. Their initial product was a series of short, handwritten news bulletins delivered by messengers throughout the day to the brokerage houses and banks of Wall Street. This was a radical idea for the time. The Gilded Age was an era of rampant market manipulation. The financial world was dominated by rumors, misinformation, and powerful speculative pools run by insiders who would conspire to drive stock prices up or down for their own enrichment. The average investor had no access to reliable information and was treated as little more than cannon fodder in the games of these powerful operators. Dow and Jones sought to change this. Their mission was to provide unbiased, accurate, and timely financial news. This mission culminated in 1889 with the creation of their flagship publication, the Wall Street Journal. Dow, as its first editor, established the paper's intellectual and ethical tone. He believed that the only way for the public to participate in the markets fairly was if they were properly informed. But to be truly informed, they needed more than just news about individual companies. They needed a way to understand the health of the entire economic system. This quest for a reliable measure of the nation's business health became his life's great work. The late 19th century was a period of unprecedented industrial growth in the United States, an age of steel, steam, and electricity. But it was also an age of extreme volatility. The economy was racked by a series of brutal financial panics and deep depressions, most notably the panics of 1893 and 1896. There were no reliable real-time government statistics to measure economic activity. Business leaders, politicians, and the public had no objective way of knowing if the country was in a healthy boom or on the verge of a catastrophic bust. Dow believed he could solve this problem. His great intellectual leap was the insight that the stock market, despite its speculative excesses, was the most sensitive and comprehensive barometer of business conditions available. He reasoned that the collective judgment of thousands of investors, all risking their own capital based on their knowledge of their specific industries, would create a consensus view that was more accurate and forward-looking than any other measure. The market's price movements, he believed, were not just a reflection of speculation, but a direct reflection of the current and, more importantly, the future prospects of American business. To harness this barometer, he needed a tool. A single stock was too volatile and idiosyncratic to be a reliable guide. He needed a way to measure the market's overall tide. His solution was the creation of a stock average. His first attempt, created in 1884, consisted of 11 companies, 9 of which were railroads, the dominant industry of the era. But as the American economy evolved, Dow realized he needed a more refined tool. On May 26, 1896, he published his new revolutionary index, the Dow Jones Industrial Average. It consisted of 12 of the most important industrial companies of the age, giants that represented the new backbone of the American economy. The original list included names like General Electric, American Cotton Oil, and the Chicago Gas Company. This index was designed to be a proxy for the productive capacity of the nation, but Dow knew that production was only half of the economic story. A healthy economy did not just make goods, it had to transport them to market. To capture this vital other half, he also created the Dow Jones Railroad Average, which would later evolve into the Transportation Average. This two-index system was his greatest conceptual innovation. It was a complete, logical model of the American economy. The industrials represented the production of goods, and the railroads represented the movement of those goods. He believed that a truly healthy, sustainable economic expansion required both averages to be moving in the same direction. One without the other was a signal of an underlying imbalance.
Để ta xem, kiếp này có thể nhận những gì? Không ngờ là không có thiên phú. Thôi vậy.
With these two powerful analytical tools in hand, Dow began to study their movements, and from his observations published in a series of editorials in the Wall Street Journal, his disciples would later codify the set of principles known as the Dow theory. The Dow theory is not a system for predicting stock prices. It is a framework for identifying the market's primary trend and gauging the overall health of the economy. It is built upon a set of 6 core tenets which we will now deconstruct. The first and most profound of these tenets is the principle that the market discounts everything. This is the intellectual foundation of the entire theory. It posits that the current price of the averages at any given moment reflects the sum total of all available knowledge and information that could possibly affect the supply or demand for stocks. This includes not just the hard, quantifiable data like a company's earnings, dividends, and balance sheets, but also a vast array of other factors. The current level of interest rates, the inflation rate, the political climate, and even acts of God like droughts or earthquakes. Furthermore, and most importantly, it also discounts the future expectations of all market participants, their collective hopes for future growth and their collective fears of a future recession. The implication of this tenet is immense. It suggests that trying to make investment decisions based on a single piece of news or a single fundamental data point is often a futile exercise, because that information is likely already in the price by the time the average person receives it. The price itself is the most complete, up-to-date, and relevant piece of information available. The job of the analyst, therefore, is not to act on the news, but to study the price action of the averages to interpret what the news means for the market's trend. This idea, formulated in the 1890s, was a radical departure from the rumor-driven speculation of the time. It was the first formal expression of the concept that would, nearly a century later, be called the efficient market hypothesis by academic economists. It is the bedrock principle that allows for the study of price charts as a valid form of analysis. This brings us to a foundational debate for all modern market participants. Do you believe Dow's century-old principle that the market